No fanfare. But if you've spent enough hours with the tape, you begin to notice the small signals. That's where the difference lives, between those who make money and those who merely hope they will. Real fortunes don't come from guessing or gambling. They come from seeing when the tide is about to turn and riding that tide while others are still scratching their heads. Ever watch a stock rip higher and think, why didn't I spot that earlier? That's the game I'm talking about, recognizing breakouts before the crowd wakes up. Listen, the market is always testing you. It whispers half-truths to shake you out or tempt you to buy too late. Under all that noise it leaves traces, footprints in the tape. If you're patient and learn to read those traces, you'll catch a stock before it launches. When the crowd finally notices it's too late, the easy money has been taken by the fellow who read the hints early. Don't you want to be that fellow? I've sat in plenty of brokerage rooms and watched how people behave. Most of them want action more than profit. They want to be trading every twitch of the tape, chasing each little tick. Breakouts are not about that frantic motion. They're about waiting, observing, then striking when the setup lines up. Would you rather be in 100 trades collecting nickels and dimes, or in one trade that pays you dollars repeatedly? Which kind of man ends up with the larger bankroll? A breakout rarely appears from nowhere. Before the thrust, there is usually a period of rest. The stock coils like a spring. Price moves inside a range, neither climbing nor collapsing. The amateurs get bored and sell. Meanwhile, the professionals watch quietly. They understand something is taking shape below the surface. Have you seen a stock sit quiet for weeks and then suddenly jump 5 points in a day? That isn't luck. It's a breakout, and the signs were there if you knew how to look. The market is a crowd, and crowds behave predictably. They panic together, they cheer together, they get complacent together. A breakout is simply the instant the crowd wakes up to what the tape has been whispering all along. But if you're sharp, you are already in. You don't chase. You let the crowd come to you and pay you for being early. Isn't that a better way to play? Now here's the trap most fall into. A stock creeps up a little and someone cries, "Break out!" They jump in only to watch it drift back lower. They sell in irritation. The next day, the real move begins without them. Why does this happen? Because impatience misreads a feint as the real thing. The market delights in tricking the eager. It shows a hand, then pulls it back to shake out weak holders. The real breakout comes with conviction, with volume and force. It doesn't sneak out quietly. It announces itself if you have ears to listen. When I used to stare at the tape, I learned to notice character. I'd see a stock rise above resistance, but the tape would look lethargic, volume thin. That was a head fake, and sooner or later it would slide back. The real breakout brings the tape alive, orders pour in. The stock pushes through resistance and keeps going. That's the sign real money is behind the move. Professionals with deep pockets don't play coy. When they decide to act, they push with authority. Psychology matters. The crowd wants to get in early. Fear of missing out is their Achilles heel. The market uses that hunger to bait them, a feint to lure in hopeful buyers, then a reversal to harvest their cash. After the weak hands are shaken out, the stock is free to run. Smart money waits for that exhaustion, then steps in and drives the price. You often see the strongest moves right after most people give up. That's a lesson in patience. False breakouts are timid. They poke above resistance but lack conviction. They trigger stops and attract eager buyers, but they don't have the strength to follow through. True breakouts are different. They charge, they don't hesitate, and they don't look back. The difference is obvious once you've trained your eye. A weak move stalls quickly. A strong move keeps climbing. The tape, the volume, and the behavior after the breakout reveal the truth. A real breakout holds its gains, finds support at the new level, and continues upward. A fake sinks back into the old range. One of the most painful lessons is being shaken out just before the real move. You sell in disgust after a false breakout, then the market bursts higher without you. Not only do you lose money, you lose the confidence to act when the genuine move appears. That hesitation can cost you far more than the immediate loss. So how do you tell the difference? Look for volume, for clean follow-through, for a price that doesn't retreat easily. A move backed by real money looks and feels different. It has weight. Watch dips closely. Most folks panic when a stock falls. I ask instead, how far down does it go before buyers show up? That question tells the story. If every retracement stops higher than the last, someone is supporting the stock. Supply is being absorbed. A string of higher lows is a trail, evidence of accumulation. When you see 50 become support, then 51, then 52, you don't need gossip or headlines. The tape tells you who's quietly picking up shares. When supply dries and demand builds, eventually the stock has no option but to rise. The speed of rebounds matters. In a weak name, drops linger and sellers win. In a strong name, dips are short-lived. The stock snaps back like a rubber band. Fast rebounds and rising floors are the shadows of big hands at work. The crowd underestimates these signals because they look quiet, nothing dramatic, but steady, quiet strength often precedes explosive moves. The market reveals its intentions if you're willing to watch. Volume is the proof. Rising support on thin volume might mean nothing. Rising support on heavy buying is evidence of conviction. When you see significant bids appear on downswings, someone with size is building a position. They aren't hunting pennies. They're planning a larger move. Those odd volume bursts, buying when no news is out, are the clues professionals act on. Wouldn't you rather follow the tape than the headlines? The market is an auction. Price gravitates to where buyers and sellers agree. If buyers are stepping up at higher levels, demand is overcoming supply. That's the core of breakout mechanics. Watching the lows often reveals more than watching the highs. Most traders obsess over highs and miss the accumulation beneath. The stock is being passed from nervous holders to confident ones. This transfer sets the stage for a breakout, but it's not enough to see a couple of higher lows and act. Patterns matter. One bounce means little. Several in sequence mean accumulation. The more times the stock finds a higher floor, the stronger the case. Patience wins. Don't confuse hope with signal. Early entry isn't guessing. It's acting on evidence, higher support, volume on up days, quick recoveries on dips, resilience when the broader market wobbles. These are the footprints of strong hands. Many traders want a mechanical rule, buy when price ticks a point above resistance. But a rule can't read conviction. You need judgment, a feel that only experience builds. Early entry is not trying to pick an exact bottom. It's positioning before the crowd. You don't need perfection, you need signs. And you need the discipline to act on those signs when they appear, even if it feels uncomfortable. Being early is lonely. You buy when there is no applause, when the crowd thinks you're wasting time. Most people want confirmation. They need others to nod. The market doesn't reward social proof. It rewards foresight. To be early, you must be willing to sit with discomfort, to trust the tape when no one is watching. Do you have that stomach? Or do you need the crowd to hold your hand? False moves erode confidence. They make you timid just when real opportunities come. The trick is training your eye to distinguish weak probes from forceful runs. A true breakout is obvious. The price doesn't fumble through resistance, it surges. Volume supports it, buyers swarm in, and the stock doesn't retreat easily. That's when you know the professionals are playing, and that's when you want to be on their side. I've watched stocks creep higher, quiet as a mouse, while everyone chases the noisy names. Those steady, unspectacular rallies often preceded the big explosions. When the crowd finally notices, the stock goes vertical, but the profit has already been collected by those who were paying attention. Experience teaches you to value quiet strength over loud noise. Don't mistake early entry for blind optimism. Many traders convince themselves they're early when they're merely gambling. True early entry is methodical. It rests on a pattern of rising support, meaningful volume, and resilience. It demands discipline. It asks you to have the courage to buy when the answer isn't obvious and to sit through the boredom until the crowd does the rest of the work for you. You don't have to catch every breakout to get rich. A handful of big winners will out-earn 100 small, choppy trades. Focus on moves that show power. Ignore the timid pokes. Let the market test the weak hands and then step in when the exhaustion has cleansed the field. Position yourself where the odds favor you. Observe how a stock behaves after an initial thrust. A false breakout usually retreats into the old range within a day or two. A true one holds the higher ground and builds new support. Look for that behavior. If a pullback doesn't erase the advance, the breakout is likely real. If the price collapses back, you were looking at a bluff. One more practical tell: watch for quick, decisive follow-through after the breakout. If the stock pauses and the tape goes quiet, be cautious. If buyers keep stepping up and the price pushes on, the breakout has legs. A strong move rarely needs to be coaxed. It runs. The market exposes its hand for those who study it. The footprints, the series of higher lows, the quick rebounds, the bursts of volume on quiet days, tell you when a stock is under accumulation. You don't need headlines to tell you what's happening. The tape does. Professionals don't wait for morning papers. They act on what the market itself is saying. That's how they get in early. Remember this: the crowd always comes late. They buy when the story is already public and the move is halfway done. Meanwhile, the professional money is already in place. The difference between a fortune and frustration is timing, being in before the crowd or after it. Do you want to be the fellow buying at the top after the party has started, or the one already sitting comfortably when the crowd rushes to pay you? Training your eye takes time. You must sit and watch, learn the character of moves, notice the way strong stocks behave differently than weak ones. You'll begin to see the telltale signs of accumulation: higher floors, heavy buying on dips, resilience in weak markets. When those signs line up, you act not out of hope, but because the tape has shown you the case. Finally, the courage to be early and the patience to wait separate profit makers from the frightened. Early entry isn't a magic trick. It's an earned skill. It requires discipline, observation, and the willingness to stand alone while the crowd dithers. When you master that, you'll find breakouts stop being surprises and start being opportunities you anticipated. Be the trader who reads the footprints in the sand, not the one who stumbles after the crowd.